The market's shifting, and the Fed just put a dagger right in the middle of it. They made a decision to hold the rates a couple of days ago. And the housing market conditions are very challenging right now than it's been in decades. So if you have a real estate agent telling you that the rates will come down and now's a great time to buy, a recent Fed communication suggests rates could stay elevated longer than most people expect. But very few buyers really understand what this really means for their purchasing power. So I'm kind of go over that right now. So if you're thinking about buying or even selling in the next 12 months, just understand some of these market dynamics. Save you money. Make sure you want to save money. Save thousands of dollars by knowing about these things to avoid these costly mistakes that other people are making. And if you stick around to the end, I'm just going to reveal like a hidden clause that are in purchase contracts. Most of the purchase contracts have it, and it could legally force you to buy a house even if your mortgage gets denied. And it's happening to buyers right now and costing them their entire down payment. So you want to keep an eye on this. So I'm going to give you a completely different perspective than I normally do in my videos, but I need to get this out there. I've been analyzing housing and interest rates for years. What I'm seeing right now really disturbs me, and I think it requires serious explanation. So over the next 20 minutes, I'm just going to break it down exactly what's happening with the Fed and then the mortgage rates as well, and why your housing costs might get even higher. Let's get into it. Let's start with the Federal Reserve. What's happening there? Because this has massive implications for mortgage rates. Situation is there's a discussion about naming a new Fed chairman, even though Jerome Powell's term doesn't end until May 2026. That would be absolutely fabulous. In my mind, I feel like he's just holding us back. Now, he has almost a full year. So why should you care about this Fed leadership? Well, because financial markets are extremely sensitive to changes in monetary policy leadership. And when there's uncertainty about who will be making interest rate decisions, it creates what economists call policy uncertainty, right? Now, what does the data show? Well, when markets are uncertain about future Fed leadership, bond yields tend to be more volatile. And since mortgage rates are closely tied to bond yields, this volatility gets passed directly to you, the home buyer. And since the Fed made this decision, they've been getting a lot of grief about this. So there's potential candidates for his position. They have different approaches to interest rates. Some favor more aggressive rate cuts, while others prefer keeping rates higher for longer to ensure inflation stays under control. Well, what I would like is what Trump wants. The Trump administration knows what they're doing. They have it all tied into their whole plan. And the uncertainty is showing up right now in the bond market pricing. Financial analysts are watching this closely because historically when there's confusion about Fed direction, their policy direction, mortgage rates tend to stay elevated as lenders price this additional risk. In reading several articles, I found that one economist, I forget who it was, said that uncertainty about monetary policy leadership typically adds a risk premium to long-term interest rates. Do you want to be buying a house and have this risk premium? No. That could be why a lot of people aren't buying right now, why homes are staying on the market a little bit longer. It's really a crazy time with real estate right now. Because the bottom line is, regardless of who ends up leading the Fed, the uncertainty itself is likely keeping mortgage rates higher than they would be otherwise. So let's talk about what actually happened at this Fed's most recent meeting. Because I think the details matter. Some of the headlines are just, these videos, you spend all day watching these videos and really not getting the real news. Now the benchmark rate unchanged, didn't move, 4.25 to 4.5. But the really crucial thing is that they maintain their projection of only 2 rate cuts for 2025, despite the ongoing pressure to cut these rates and be more aggressive. But the key to all of it, of what they were saying, is they mentioned that near-term measures of inflation expectations have moved up over recent months. They're using inflation as a reason. And they cited tariffs as a contributing factor. They don't want to say they just don't want to do whatever Donald Trump wants to do. They're just saying that. I think there's a lot of this clashing going on. So what are they being? They're being cautious. But things are so different today. The Trump administration is organizing everything, getting rid of all the debt, doing things that have been going on for a while that didn't help the American public. Powell, he thinks that we're going to wait before making any rate cuts. So from the housing perspective, it means the Fed isn't in a rush to bring rates down, even though mortgage payments are at historic highs. So we have an average mortgage payment of something like $2,290. It's the highest that's ever been recorded, yet the Fed's approach suggests they're They're more concerned about inflation risk than housing affordability in the short term. I don't agree. What do you think? Put your comment below. Now, the mortgage rate forecasters are saying, well, who's that? We got Mortgage Bankers Association. They project rates will increase to 6.7% by year end, and that's their optimistic scenario. Many analysts who were predicting 6% rates have revised their forecast upward because of this announcement. So I think this is just a disconnect. It's very real. Home buyers are hoping for relief. Fed policy suggests that rates will remain elevated through 2025. Big backlash the day after, and now saying they're considering lowering it in July. So after all these people came out and gave them all kinds of grief, now they're thinking about lowering it in July. That's great. So I don't think this should be a political move. It's a move to make housing more affordable. That's what it is. They have to keep it at that, not a political move. A lot of these people who run in the government have been there for a long time and they don't do anything different. Where the Trump administration is shaking things up, making things moving and shaking, they're just back the way they used to do as business as usual. Do you think that they did the right thing? What do you think? Put some comments below. So what you really need to look at is the housing market data. Numbers. They tell a story. I love numbers. I'm a numbers person. A lot of people don't hear the number story because, one, we have this rate lock-in effect. We all know about it. It's crucial data that 82% of homeowners with mortgages have rates below 6%. And even more striking is that 25% of rates below 3%. So what does that mean in dollar terms? The average lock-in effect is worth $47,800 per year. That's how much extra a homeowner would pay annually if they gave up their low rate for today's rates. That is a powerful incentive to stay put, right? So what's the result? New home listings are still running low. They're 25% below normal levels. People simply cannot afford to move and give up their low rate. And we've been talking about this for a while, but what's the contradiction to all this? Well, despite the historically high rates right now, when I got into real estate, the rates were like 10%, but despite the high rates, home prices rose last year nationally 4%, higher here in Pennsylvania, my area outside of Philadelphia. And the median price point now is at $407,000. It represents a 50% increase since 2019. And on the other side, we have inventory, right? These numbers are telling another story. There are 27% more homes on the market compared to last year, but sales are only up 4%. That means homes are taking longer to sell and price reductions are becoming more common, mostly due to the home selling sharks. I wrote a whole book about the sharks. And I have my little prop here, the shark. And they bite really bad in a buyer's market. And you have to knock down at least 8 of these sharks. You've got the realtor shark, making sure you have the right person helping you with the marketing and all the staging and everything. And you have your inspection shark, making sure you get the inspection done ahead of time. You have your photo shark, the right photos, your staging shark, what are the low-cost fix-ups you're going to do to get your home on the market. You've got the marketing shark, pricing shark, coming soon shark, and the showtime shark. That's the big one. All these sharks are lurking around, even more so in this type of market. And even more so, you need a really good realtor, your first shark, who can fight all of them for you and get you focused. Now for you buyers, the financial reality is with the median price of $407,000 and a 7% mortgage rate, you're looking at a monthly payment around $2,700. Depends on the taxes and the insurance. And according to census data, this exceeds the median monthly household income in many markets. Major financial institutions are projecting the housing market will remain largely frozen through 2025. I certainly hope not. And they believe that home price growth will slow down to about 3%. Still positive though, but just slower than recent years. So yes, we're in a challenging environment right now. And the Fed does acknowledge that high rates are constraining housing activity, but they're just prioritizing broader economic stability in their minds over the housing market relief. Just even a small decrease in rates, would say just under 6.5%, would simulate the housing market. People would buy homes, and they buy furniture, accessories, construction materials. It just helps many other businesses. It stimulates the local economy. But the bad news is they're saying that inflation accelerates, which it's actually come down. I'm not sure what they're talking about here, but due to some economic factors, they're saying mortgage rate could move higher than lower. So the possibility is factored in current rate projections. That's why the rates are higher. The volatility, that little premium thing, the risk that the mortgage companies put that little bit of extra on it, that's what's happening right now. So let's break down the cost. What does these rate levels actually mean for your monthly budget? Because this is where the reality is, right? So you buy a $400,000 home. I don't know where you're going to get one in our area, but say you buy a $400,000 home at 3% 2021 rates, that's a mortgage payment of $1,686 a month, principal and interest. But at the current rate, you're looking at $2,661 a month, principal interest. That's almost $1,000 difference, or about almost $12,000 a year. That's just a little part of it, the mortgage payment. You have property taxes that are going up because home values have risen. You get homeowners insurance costs have really surged, in many areas doubling over 2 years due to increased claims and reinsurance costs. And additionally, you have recent data that says that 20% of households with car payments now pay over $1,000 monthly just for their car loans. And you combine that with the current mortgage payment, housing and transportation costs alone can exceed about $3,600 a month. That's a lot of money. But there is one opportunity in this market that many buyers overlook, especially if you don't have a lot of new construction in your area. Builders have currently 9.5 months of supply compared to just 4.2 months for existing homes. So the excess inventory is driving significant incentives. Builders are offering rate buy downs worth $30,000 or $50,000. They're paying your closing costs, providing design center allowances of like $20,000, just went up to one. Has to go pretty far in my area to get this, but it's there. And when you calculate it properly, these incentives can effectively reduce the purchase price by 5 to 10%. So what's the insight here is that builders prefer offering incentives rather than reducing list prices because it doesn't affect comparable sale data that impacts future pricing. Okay, very important. So what does the data suggest? What are some of the projections? Well, I'm thinking based on current economic indicators and Fed policy signals, some of the housing market analysts are projecting for interest rates. They're forecasting, the consensus among many of them is that the mortgage rates will remain between 6.5 and 7% through 2025. But then since the announcement on Thursday that they're going to keep the rates the same, the number of high-ranking economists are demanding a rate cut. And they're really putting pressure on it. And now we're reading that we might have a rate cut in July. So I'm keeping my fingers crossed for that. However, the 5% rates that many buyers were hoping for aren't projected by any major forecasting group. I don't know. Let's see how much pressure we can put on them because it needs to get done. What about home price projections? They show continued growth, but at a real slow pace, much slower. Fannie Mae is saying 3.5% price growth in 2025. While other institutions forecast 2 to 4% annual increases through 2029. So there's regional variations as well, and it's really significant to understand that. Markets with active new construction, particularly in the Sun Belt, they're expected to see more transaction activity. And where you have supply-constrained markets, especially where we're at here in the Northeast, in the Philadelphia area, we're going to see continued sluggish sales volume. But the construction industry right now, it just has its own challenges because like 30% of construction workers are immigrants. So any changes to immigration policy could impact construction capacity and by extension, housing supply. I was reading that one analyst predicted that we may see the development of a two-tiered market where areas with new construction and builder incentives maintain activity while markets dependent on existing home sales remain constrained. So we'll see what happens. It's only June, but there are some things happening and next 6 months should be pretty interesting. There is a demographic factor that's also important I want to talk about is the first-time buyers. They typically drive market activity, but they're being priced out right now of the markets. They're definitely priced out. And that could suppress overall sales volumes as well. So what can you do? So based on current market conditions, there are specific strategies for different situations. So if you're a potential seller, pricing strategy is critical in this market. I talked about that in my last pricing video I just did, that homes that sit on the market too long face increasing price reduction pressure. Now the data shows that properties priced correctly from the start, that little bullseye area in the graph here I'm going to show you, they're selling. if you price it in that bullseye. While overpriced homes are just accumulating market time. And if you currently have a mortgage rate below 5%, just carefully calculate the true cost of moving. The rate lock-in effect might make staying put something you should do. And that might be the optimal choice for you, unless you have other compelling reasons to relocate. And for buyers, just focus on markets and property types where sellers are motivated or ones that need work. And check out new construction offers. That's the best negotiating opportunities currently there. They're giving builder inventory levels are building up, and they're giving these great incentive programs. I would say don't wait for perfect rate conditions that might not materialize. And if you're financially qualified and planning to stay long-term, say 7 years or more, the current market conditions may represent opportunity for you. I don't know. If you'd like to discuss that, set your comments below, get something in my calendar. I can talk to you about it. Are you an investor? Wow, the secondary and tertiary markets where price appreciation has been more modest, this may offer better risk-adjusted returns. However, you got to be aware that these markets typically experience greater volatility during economic uncertainty. So, I don't know. We've got both sides of the story here. But the key principle is make decisions based on your financial capacity and long-term plans rather than trying to time market conditions perfectly. Now, here's a dangerous contract clause I mentioned that could cost you everything. And it's happening to buyers right now in this volatile rate market environment, okay? Now, most purchase contracts contain what's called a financing contingency. But what agents are explaining is that if rates spike after you're under contract and you no longer qualify for the loan amount you applied for, but you still technically qualify for a mortgage at the higher rate, even if it's for less money than the purchase price, many contracts consider your financing contingency satisfied. Make sure you put that rate spread in there. Make sure it's not more than 7%. So which means that if you don't put that spread in there and you just put the one rate, it means you could be legally obligated to complete the purchase even if you can't afford it, or just, you would lose your entire earnest deposit. And with rates are changing now weekly and lenders are really tightening standards, I'm seeing buyers lose $10,000, $20,000, $50,000 their deposits because they didn't understand this clause. The solution is always include a specific rate and loan amount thresholds, like I said, in your financial contingency on your agreement of sale. Don't just say subject to buyer obtaining financing, because your agent should be protecting you from this. But most don't even know that this trap exists. Make sure you have that other number in there and don't make it a big spread. They might put in like, oh, from 6.5 to 8.5. No, it should be 6.5 to like 7. Just make sure it's the right number. So right now, the housing market is a perfect storm right now. High rates, shifting policies, cautious buyers. It's just reshaping the industry right now. If you're planning to buy or sell or just want to wait it out, just understand the market's underlying trends. It just gives you a real edge. And if you're leaning towards selling or just curious why homes are sitting longer, don't miss our next video. Buyers are out, sellers are stuck. Here's why. It's a great one. I break down why overpriced homes are crashing in 2025. And no, it's not just about interest rates. You'll learn what today's buyers are really looking for, why listings are stalling, and how to position your home to win, and my model home mindset. Watch now and outsmart the market before it moves on again.